Welcome to the Florida Divorce Podcast, your source for the information you need to successfully get through your divorce and into the next exciting chapter of life. Now, here's your host, Attorney Scott Kalish.
Hey everybody, my name is Attorney Scott Kalish. I am a divorce and family law attorney here in South Florida. Today I'm joined by my friend Jason Soman. He's a forensic accountant here in South Florida. He helps a lot of family lawyers. Thanks again for coming on the podcast, Jason.
Hey Scott, thanks for having me. Big fan of the podcast. Happy to be back here with you talking about Florida divorce.
Of course. And today we spoke before, jumping on the air here, right? If we can call it the air, right? It's kind of weird to say, but talking about business valuations and how businesses play a role in a divorce case, right? And specifically how they're handled in a divorce case. And just for everyone listening, right, if you're the owner of a small business and it was a business that you started or, increased the value of like during the marriage, then it's probably going to play a role in your divorce case, right, Jason?
Absolutely. So business is kind of just like any other asset, and businesses could be very small. It could be a lemonade stand, or it could be a multi-billion-dollar corporation. So depending on what type of business it is, it could really impact a Florida divorce in many ways. And oftentimes, and I'm sure you see this a lot of times people, a lot of wealth that they have in terms of their marital net worth is tied up in the business. So these are pretty important issues in a divorce case. And depending on what the value is, could really change the outcome of what's ultimately the spouse, one or both the spouses walk away with. Sure.
And I think, at least from a legal perspective and a divorce perspective, usually the issue lies in the valuation of the business. That's usually where the dispute is. The person that I think is looking to keep the business is usually saying it's worth a lot less than the person that wants to get their, interest paid, right? That wants to get paid out for their half, let's say, if it's a totally marital business. Would you think that, would you say that that's accurate?
Yeah. So unlike a publicly traded corporation, a privately held company, I can't call up Fidelity and sell my stock in a couple days. I don't know what it's really worth. So what we do is we specialize in privately held business valuation, it's actually a pretty in-depth process to do a business valuation of a privately held company, because we are trying to measure something that there's no readily ascertainable market for. So, we undergo a thorough valuation process. We have to look at a host of qualitative factors, how the business is run, the business's reputation, customer concentration, and try to assess the risks of the business. And we're also trying to look at what kind of cash flow the business has, what types of assets they have, things of that nature. I'm happy to talk about in more specifics.
Sure. So just to give people a visual of exactly what we're talking about, right? For example, husband and wife, maybe they own a dry cleaning business, right? You can't just go to the MLS of businesses and look at what your average dry cleaning, business is selling for, right? It's not as simple or straightforward as doing that, right?
Mm-hmm. So as business valuation professionals, in addition to being a forensic accountant, I'm also have credentials in business valuation. And as I'll go over, there's a lot of interplay between the two. So it's not as they kind of go together as complementary skills. But generally speaking, any business, any asset, there's three ways to value it.
Okay, let's walk through them.
Sure. So one way you could value it is you could look at the income, what cash flow or future economic benefit is going to be realized by owning this asset. So if you own this dry cleaning business and this dry cleaning business generates $300,000 in profit every year, we may value the business looking at what the profit is expected to be on a going forward basis. And then we determine what that is worth today. And what that is called is the income approach.
And when you have the income approach, is there a specific time that you're looking at it for? For instance, if someone had a dry cleaning business, right, they planned on owning it for the next 30 years and it makes $300,000 a year, would that play into your valuation overall?
Sure. So a business valuation, just the way that the theory works is that we're valuing this kind of into perpetuity.
Okay.
And business valuation as a subject, and also business valuation in Florida divorce law could kind of be two different things. But generally speaking, we're valuing this into perpetuity, right? Because let's say I sell this 10 years from now, whoever's buying it will operate it. And then, there's an assumption that these cash flows are going to go into perpetuity. And the way that it works is we determine what the present worth of those cash flows are in the future today.
Based on looking at what?
Well, we assess the risks. So, if it's a sure thing that you're going to get the $300,000 next year, the business is going to be worth more than if it's very uncertain, right? Like if you're selling something that, they're
kind of selling. I give the perfect example, I think. Right when COVID-19 started, everyone was like in the business of selling masks, right?
Exactly.
Obviously, that ended relatively, soon. Shortly after the pandemic started. I mean, it depends on where you live, but I mean, I think suffice it to say, you go out in public right now in 2023, not many people are wearing masks anymore.
Absolutely. So if let's say my dry cleaner, for example, my only client was Kalish and Jaggers, and I just only dry cleaned your guys' stuff, that's a lot riskier than if I have that business spread across many different areas. Some other things to consider are, regulation. Are they going to crack down on dry cleaners and enact all these certain laws? And the risk is really, the way that we calculate risk is we look to the public markets, right? And then what we do is we build up the risks. So first we look, okay, well, what is the risk of investing in a treasury security? That's what we call a risk-free investment. So that's, a few percentage points. I mean, I know they've changed a lot recently.
Sure.
Then it's the risk of investing in equity markets. Then we look at the risk of investing in smaller types of equities, right? But a business like a dry cleaner is going to be even more risky even beyond that.
Yeah.
Right.
Sure.
So what we do is using the income approach, we'll look at what the earnings are expected to be or what and a lot of times we base what they're expected to be based on what they are historically, right? So like, let's say the business did 400,000 in profit, 300, 200, 400, maybe 300 is a good proxy in that example. So what we'll do is we'll look at what the cash flows are going to be and then what's the risk of achieving those cash flows. There are subjectivities, right? Because two different business valuation people could have two different assessments of risk. There's almost unlimited risk factors. One of them could also be like someone who really runs the business. It's all tied up in one person. And that's could be an issue potentially of personal goodwill. And then the next way to value a business is what we call the market approach. So in the market approach, we look at transactions of other dry cleaners, right? Like I may be able to find transactions using databases that business valuation analysts have, where I may be able to find enough comparable transactions of dry cleaners, or maybe in this instance, there might be businesses that are kind of ancillary to dry cleaners that may also be able to be used as guidelines.
Sure. When you say like comparable transactions, you mean by like, hey, kind of like pulling comps in the real estate
Exactly.
market?
That's like the equivalent of looking at, the MLS and seeing what things sold for price per square foot. But with a business, there is what they call a multiple, right? So if the business sold for 3 times profit, that's a 3 times multiple. So
sometimes industries, my understanding is sometimes industries have like standard, like just common multiples that like those businesses will sell for, like if it's an engineering firm or if it's a law firm or maybe an accounting practice. Mm-hmm. Is that your understanding?
Yeah. So I think it depends. I think it really depends on the business, the growth of the business. And when we evaluate what type of multiple is the appropriate multiple, it's really kind of a similar analysis of risk as what we spoke about before.
Yeah.
A company that's growing really fast may demand a higher multiple, right? If you see a company that's, a dry cleaning company that's doing 100,000 in profit, 200, 300, 400, that's going to look better than something that's just been doing 300. I mean, it all depends. And it's very hard sometimes to talk in absolutes because every case is so different.
Yeah.
There's facts and circumstances at play. And then the last way to value a business is the asset approach. So like an asset approach is really what we're saying with an asset approach is these are the market value of the assets. This is the market value of the liabilities. And that's kind of what we're saying is the business.
So when you look at a business's assets, what specifically are you looking for?
So, let's use the dry clean example, right? So we may look at the cash account. We may look at, I don't think a dry cleaner has receivables, maybe, but, we may look at the dry cleaning machines themselves. What are those worth? What security deposits do they have? And then we may look at liabilities. Do they have a mortgage on anything or credit cards or things like that? So the asset approach is a good method sometimes with like a real estate holding company or something that doesn't derive most of its value from earnings or profits, but more is a heavy asset intensive business. So the asset approach could also be looked at as like a floor value, right? Like,
what do you mean by a floor value?
That's a good question. So like my dry cleaner cannot, like, I don't think it would be appropriate to say that the dry cleaner is worth less dead than alive.
Yeah.
So like if you have a cash account machinery, like you can't say, okay, well, the comps are giving me a value of $1 million, but the assets are worth $1.5 million. Like if you own that dry cleaner, you're not going to sell it for less than $1.5 million because you could literally close the dry cleaner and sell the assets and
the assets and
exactly
cash out. So that's like literally when you say the floor, that's like the least amount that it's going to be valued at.
Generally speaking, of course, there's exceptions and outliers and things like that.
Yeah. Okay. And you mentioned something before about personal goodwill.
Mm-hmm.
And I, as a, practicing family law attorney, have heard that term before. And can you kind of explain to the audience exactly like what personal goodwill is and how it relates to business valuations?
Sure. So let me just explain the concept of personal goodwill. So personal goodwill at its face is the reputation and skill of an individual, right? So the complexities of valuing a business in divorce is, I think the best examples are like law firms or accounting firms, right? Like,
or doctors too,
or
right?
doctors, exactly. So like, is there a business value to Kalish and Jaggers, or is it really just Scott Kalish?
Sure. I think people, know the doctor example the best because everyone has a doctor. Everyone's
Mm-hmm.
been to a doctor. Some people have never been to an accountant per se, or
Mm-hmm.
maybe they use TurboTax, or maybe they use, whatever, right? Like a, tax service that's not an accountant. Maybe they've never hired a lawyer, but like everyone's had a doctor. So let's say like Dr. Brown or on Main Street in wherever America, right? People go to Dr. Brown for a reason because they like him, they know him, they trust him. He's been the family doctor, let's say for 10 years. But if Dr. Brown all of a sudden decided to, pack up his office and move somewhere or sell his practice to somebody else, that you have no idea who that is. Like, would you go to Dr. Brown? Is that how personal goodwill works?
Yeah. So, first, I also I'd be remiss if I didn't explain the concept of goodwill, right?
Sure.
So like using the dry cleaning example, let's say valuing it under the income approach, I came up with a value of $1 million. And then I look at the assets of the dry cleaner, and the assets of the dry cleaner are only $500,000.
Yeah.
So that $500,000 difference in value is what we'll call goodwill. And what that is, that's intangible value, right? That's the fact that it's not just assets. There's other intangible assets there that are able to take the dry cleaning machines and turn them into more value, right? But then the issue is under Florida law and other states as well, the personal nature of the goodwill is not a distributable marital asset, right? Like you shouldn't, well, this is what Florida law says is like you shouldn't have to pay your spouse for value that is you, right? Like that's not an asset that could be distributed. So that's really the concept. So then the question becomes is, okay, so this dry cleaner has $500,000 of total goodwill.
Yeah.
How much of that is goodwill attributable to the owner of the dry cleaner? Like maybe there's someone that knows really well, how to run this business and it's all tied up in them.
Or maybe it's just someone that like is the face of the business. And like when you walk in the door, you're greeted with like a big smile and it's like the whatever, the most friendly dry cleaning guy ever. And you just enjoy going and dropping dry cleaning off, right?
Yeah. I mean, it would probably be in reality and it would probably be unlikely where a dry cleaner would be 100% personal goodwill. I mean, you see it all the time with lawyers, accountants, doctors, right?
Yeah.
But then the other side of the spectrum,
because it's like a service. They're a trusted professional.
Yeah, and it's based on the skill and the reputation. That's why people are coming there, right?
To that person.
Because then it's like,
and the experience too. I mean, especially with lawyers. If one particular lawyer, right, has a ton of experience doing type of case, right? Obviously, he's going to be more valuable than another attorney that doesn't have that experience.
Mm-hmm. Yeah, and you also have to keep in mind that if you don't have a non-compete, right? So the way that it works, in my understanding from speaking to attorneys and judges and reading some of the cases, is a Florida judge is not going to force someone to sign a non-compete, right? So it's like the question then becomes is, what is the value of Kalish and Jaggers if Scott Kalish goes across the street and opens up a new law firm? So I think these are kind of the issues that we really have to analyze. And it really kind of it's a good interplay between legal and valuation, because, the valuation is one thing, but then it's like, okay, well, how much of that valuation is attributable to the hard assets, the cash, the furniture, the equipment? And then how much is it attributable to the enterprise? And then how much is attributable to the individual? So this could be a complicated process. And a lot of times it's absolute, right? Like if you own a real estate investment, it doesn't really matter. Like if you're not involved with running the property or something like that, that could be, it doesn't depend on the skill of an individual. It's kind of just holding an investment. And then the other side is like a doctor or a lawyer. So it's really, those tend to be more black and white in my experience. It's the ones where there's an in-between, right? Like a 10-person law firm, like that might have some value to the actual institution.
Sure. Like the name of the firm can just have.
Exactly. There's law firms out there now where the name on the front door, that person's been gone for a very long time.
Yeah.
So that's going to be a different dynamic than a firm that's, a solo practitioner.
Sure. I can imagine that this is a very gray area in what you do, and there could be definitely a difference in opinion, right?
Yes. So a lot of times with professional practices in the state of Florida, what ends up happening is we'll turn to the asset approach, right? Because we may say, okay, well, a lot of the intangible value right here is tied up in this individual. So then what does that leave the business, right? It leaves us with the law firm example, right? It leaves us with cash. It leaves us with receivables, less the debt.
Yeah.
And I think that's typically how professional practices and let's call it high goodwill businesses, high personal goodwill businesses operate around here in terms of divorce. There's all shades of gray. So, it's hard to really give absolutes, but there's things could definitely be complicated and there could be potentially millions of dollars at stake. And a lot of times when we're doing a business valuation, there may be a competing business valuation on the other side. And it may be a matter of, well, whose opinion is better supported, whose opinion is more credible. And if the case doesn't settle, sometimes what will happen is you'll have two dueling valuation experts. A lot of times, though, clients may hire us as a neutral where we work for both sides and we will value the business and we'll share our conclusions. And potentially if one of them wants to challenge it, maybe they'll get their own. So, there could be 1 to 3 valuation professionals in any divorce case. And it happens all the time, as you could imagine. It happens a lot where, the side that owns the business will say that it's not worth that much. And the other side will say that it's worth a lot more than that. Then the issue comes in and where the forensic accounting comes into play is a lot of times people are saying, well, we were talking about the dry cleaning, the $300,000 in profit, right? Well, it's like, well, I don't think that $300,000 in profit is really $300,000. They got a paramour or they're funneling money somewhere else. So like
maybe their personal expenses.
They're paying their personal expenses. Personal expenses is very common. Like even the most straight shooting people like have a cell phone that's, what I mean? So
paying car insurance,
something, or maybe it's just a mistake, right? They take out their credit card. And we also, as valuation and forensic professionals, get into these, I'll call it debates, right? Where it's like, okay, well, that's really a business expense. That's not really a business expense. So that's why this valuation and the forensic accounting goes so into play, right? Because whatever the earnings are, whatever the assets are, that's really relevant in evaluation, right? Because we look at earnings and we look at multiples of earnings and we look at assets. So to the extent that any of those numbers, the valuation is only half the equation, the inputs are the other half. So a lot of times we're what we call looking under the hood of the business to really get at what the true earnings are, what are the true assets. And that could be a very complicated thing to answer sometimes. And sometimes, we're able, when we're working for the spouse that doesn't have the money or access to the business, sometimes we're able to find significant stuff that really moves the needle. And sometimes it just also looks bad, like if this person's sometimes you're able to gain leverage that way where it's like, okay, well, they didn't disclose that we found all this stuff and it increased the value X dollars. And I'd say like one of my favorite parts of being a forensic and valuation professional is really being able to kind of take the numbers and really dig a little deeper into them and find out like what's really going on. Because when I'm working for the non-titled spouse, obviously there's a cost benefit to us digging, but if I'm able to really spend some time, be thoughtful, do a lot of due diligence, look under the books and records, really get to know the business and increase the value for our client, like that's very rewarding, right? Because I feel like I'm able to
add a tremendous amount of value.
Exactly. And it's always hard to kind of promise, you can't, the problem is sometimes you don't know going in, like, oh, if I spend this amount of time, I'm going to find X. But, we try to take a common sense approach into how we dig and look under the hood with these valuations because, sometimes what we could do is we'll say, hey, let's just like, if you suspect that something happened, maybe we'll just like kind of look at some things. All right. And maybe we'll do like a little test. And then maybe if we find some stuff in the test, we'll kind of take it to the next step because things could be a rabbit hole, especially when you're, it's not like you're dealing with someone's personal finances. When you're dealing with a business's finances, there's a lot more stuff there, right? There's a lot of transactions. There's a lot of money going around. Yeah. There's a lot of activity.
If you were talking to, let's say, the titled spouse, right? When I say titled spouse, you kind of use the term. I think it's a great term. The spouse that has the business, that's operating the business, right? Would you offer them any piece of advice if they were considering hiring like a business valuator?
Yeah, I mean, I would just always say I'm a big proponent of just being honest, right? Because like if you try to hide stuff or you try to get cute or you're trying to like things get expensive, right? And sometimes when you're on the side of the titled spouse, people get annoyed, right? Because there may be another forensic and valuation professional that's trying to turn over every stone. And I have cases like that now where it's like, I'm working for the business owner and they're asking about, $100 charge but sometimes it's not about the money, right? It's about
like the cleaning lady, like they see like maybe a check that goes to like some cleaning lady, right? For, I don't know, once a month, they want to know like, all of the information about that, maybe something like that. Like,
well, yeah, but it's also like if there's a paramour involved, right? Like even if it's $100 and it's not going to change the valuation, like sometimes people let their emotions get the best of them. And, sometimes you just got to take a step back and say, okay, well, is this really going to move the valuation? Is this really going to change things?
How about if you were talking to the non-titled spouse, right? The spouse that's not controlling the business. Would you offer them any advice?
Yeah, I would. Yeah, I mean, I think that for the non-titled spouse, I think I would like to pay attention, right? Like, I think you probably know more than you think you do, because I think a lot of times where there's smoke, there's fire. Like, we don't typically just go digging incidentally. Usually there's a suspicion, right? Oh, he or she always pulled out the corporate Amex, or, I always saw them, when we went on family vacations, they would pull out the corporate Amex. So, if you're thinking about getting divorced and you don't have a lot of knowledge of the finances, just start paying attention. Start thinking about, like, how are things being paid? What's being paid from the business? What's being paid personally? So I think that would be my advice for a non-titled spouse. And my also advice would be is sometimes it doesn't pay to chase everything. Sometimes there's value to moving on or seeing the forest for the trees.
Sure.
And I'd probably say that goes with almost any divorce issue, even non-business valuation related.
Yeah. I think that's a great piece of advice. I think that's it. We can wrap up. I think this is an incredibly valuable episode. I think people with businesses and people without businesses, right? If their spouse is operating the business, I'm sure they've, gained a tremendous amount of knowledge and kind of understand at least what the playing field looks like in this area of divorce. And I really appreciate you coming on and sharing,
Yes, thank you for having me, Scott. And also, I forgot to mention what else I think is also important to keep in mind is like these privately held businesses, sometimes they're illiquid, right?
Yeah.
Or almost all the time they're illiquid. So like,
or a certain amount of them are liquid. Obviously, the cash accounts, that's liquid. But, if they have equipment or if they have trucks or something.
Yeah. So, you may not be able to, let's say you have a marital estate worth $1.2 million, right? And the business is $1 million out of that $1.2 million. It's like, well, where am I going to get the money to pay out the 500? So like that could also create an issue where it's like, I can't take it from the business, right? Because I need those trucks. I need that cash in order to run the business. So
to pay it out.
So sometimes that creates complexities as it relates to the business being split, because it's like, okay, well, the business is worth this, and that's based on analysis and theory and inputs and so on and so forth. But it's like, okay, well, how are we going to pay it? So that opens up a whole nother issue. And, maybe that's a good topic for another episode.
Yeah, for sure. for sure. Yeah, I'll have to have you on again, which I know I will. It's always a good time. And, we always, I think, get a tremendous amount of information when you come on. So I really appreciate you coming on. If people, want to hear more from you, where should they go?
So listen to the Florida Divorce Podcast. We have an episode, a couple of previous episodes. Yeah. And you could visit us at www.divorceforensicaccountant.com. We talk about business valuation, forensic accounting, divorce. You'll see Scott. He comes on our podcast. We have a podcast called Find the Money Podcast, and we're shooting another one in a couple of weeks. And Scott was a guest previously on 2 episodes. So if you'd like to hear more from Scott, you could find him there as well.
Awesome. Well, no, thank you guys for listening. And thank you again, Jason, for coming on. If you guys have a question for me, feel free to send me an email. My email is scott@kjlawfla.com. Again, scott@kjlawfla.com.
And we're also in that Facebook group together, right?
Yeah. Also, there's a Facebook group. Yeah, that's something that we're trying to promote. Trying to start a divorce, info and support group on Facebook. If you guys are interested in joining that to get more, divorce knowledge and information, feel free to go to the show notes wherever you're listening and click on that link and ask to join the group. Something that we're just, starting now and getting off the ground. So definitely join us. I think it'll be a good experience for everybody. I think they're going to get a tremendous amount of value there. All right, guys. Take care. Thanks for listening.
Thanks for listening to the Florida Divorce Podcast. To learn the 10 secrets behind every successful divorce, visit floridadivorcepodcast.com. If you'd like Scott's help in your divorce case, go to kjlawfla.com.